Alright, yo, Z community cuties, it's your boy Tamer Z's back in the cut, and I wanted to let you guys know, if you have not watched part 1 for this video, go ahead and watch it because it's a necessary precursor for this video. You want to take advantage of the S&P market situation right now, be sure you watch it and then come back. I'll see you guys then. Now, just an overview of what we've done in part 1. We basically broke down what buying a put option is and what buying a call option is. In today's video, we're going to combine both of these bad boys together to present us with, drumroll please, the straddle strategy. Now, mandem, using the straddle strategy is perfect for situations like the one that we're in right now, where you're looking at a certain stock, or in this case, we're looking at the overall market, S&P 500, and we're like, yo, is this shit gonna go up or is it gonna go down? Like, what the hell is it going to do? And this is where the strategy perfectly fits in. Now, what the straddle strategy allows you to do is, whether the market goes up in value or down in value, you're still making profit. And if that doesn't sound good to you, my guy, then yo, relocate to like North Korea or some shit, because this is where the juice comes in, man. Now just look at this chart. If you watched part 1, this should make a little bit more sense, but just look at that. Just look at how beautiful that looks. Downside, upside, profits. In the middle, losses, and this is what we're gonna touch up on in today's video. Now remember, this strategy combines both buying a call option and buying a put option all into one. So let's look at buying a call option first. Now remember, we talked in the last video about what this does. You only make profits if the stock goes up in value. Your maximum loss is when the stock price goes down in value, and it's whatever you paid for the call option. And let's just say now we add in buying puts. Buying puts is the complete opposite. Stock price goes down, your portfolio goes up. Stock price goes up, your portfolio lost a significant amount. Now, putting this together, and this is probably the only time where elementary school math actually came clutch, but these things both cancel down. Those little flat lines that you see, both cancel out, and it gives you the shape of what a straddle strategy is. It gives you a V shape. And to put in more simple terms, if the stock price goes up, you make profits. If the stock price goes down, you make profits. But there's a little catch here, as with everything, because you can't have your cake and eat it too. This little section that you see in the bottom that's in red, this is what we're gonna break down a little bit more in depth. Now, this little red part that you see on the chart is actually due to the fact of you paying a price for both the call option and the put option. Now, there's gotta be a pretty significant move in the stock price for this loss to be covered, either on the upside or the downside, and that's where the V shape actually forms. Now let's break this down a little bit further and expand on what we learned in part 1. Now, looking at this chart over here, this is the call scenario. This is when you're just buying a call option by itself. Now, with the red flat section, which is on the left, this means if the stock price decreases from where you actually got it, you're gonna be losing the money that you actually used to buy this call option. So let's just say that you bought the call for $500. You're only gonna lose $500, nothing more, regardless of how far down the stock price goes. Same thing applies for the red scenario when buying a put option, but it's just in the opposite direction. So if you bought a put option and the stock price goes up, the maximum that you're going to lose is whatever you paid for. So let's just say in this example as well, you also paid $500 to buy this put option. This means the maximum you could ever lose is $500, even if the stock price goes to literally infinity in 21. Now let's think about it, right? Now, combining both a call option and a put option, and we paid $500 for one and $500 for the other, that means we're putting $1,000 into this total trade. This means that this is going to be your maximum loss. And I literally calculated this by adding up what I paid for the put, what I paid for the call. $1,000, pretty straightforward. Now, here's the biggest benefit of using this strategy overall, right? Now, let's just use the example from before, and let's just say that you bought this at a strike price of $5. This actually will indicate where the peak of this V is. So as you can see with this chart, right at the chin of this very sad individual, this is where it's actually at $5. Once it starts moving up a little bit more, and let's just say it gets to like $3, $4, or it gets to like $6, $7, the V shape starts moving up and you start getting to the hairline of this sad individual. Once you start getting to like the tip of this guy's head top, then this is when you start actually realizing profits. Now, whether the stock price crashes or whether it skyrockets, you're in the green, you're chilling like a villain on penicillin. Now let me try to explain this to you guys a little bit in more depth so that it makes sense with the most recent straddle play that I did with the S&P 500. But before we actually dive into that, I just wanted to give you guys a disclaimer. If you guys do not understand the full concept of this, you don't understand what a put option is, you don't understand what a call option is, and you don't understand what a stock is overall, you guys shouldn't do this. Make sure you're doing your own due diligence. This is not financial advice. I'm just showing you guys my past experiences and sharing the knowledge that I know. So just keep that in mind as we're going on. Now, how did I actually make this setup? First things first, I looked into an ETF that tracks the S&P 500. That was in Canadian dollars, because I ain't paying no conversion fees over here. Now, I actually did close this a couple of weeks back for a profit of 7%, which was pretty solid, but that's beside the point. Now, what I did is that I bought a call option for $5.60, and I bought a put option for $5.35. On top of that, I paid a $23.90 commission fee round trip. And when I say round trip, I mean like to get into the position and then to get out the position. Thanks for taking my money, Questrade. Now, knowing this information, I already know what my maximum loss is from the get-go. If we're looking at the $5.65 option that I bought, we would have to multiply this by 100, because one options contract equals 100 shares of stock. So that already gives us $560 on the first line of the call option. Secondly, we bought the put option at $5.35. Again, we would have to multiply this by 100 because one options contract is equal to 100 shares. And that gives us $535. Now, what we would do is we would add 535 plus 560. What does that give us? Quick maths, $1,095. But wait, how can we forget about our commissions? $23.90, you have to add that on, and do it on a per share basis. I'm not gonna dive in too deep into that because it's not the point here. But after doing the math, it comes up to $1,118.90. I had to look at my screen for that because, I ain't with the mental maths like that. Now, keeping this in mind, this is our max loss, and this is what I'm showing you on the graph right now. Now, knowing this with our maximum loss of $1,118.90, this is the max I'm losing, meaning I'm not losing anything more than this. And as we've touched up on before of how the P&L of a straddle looks like, we know that this is already a given. Now, we also know, as we've kind of discussed earlier, that you're going to be at a loss between a certain range and over a certain range and under a certain range, you're going to be making profits. So let's figure out what these ranges are. Now, first things first, let's actually think about our maximum loss point, because now we know what our maximum loss dollar value is, but at what stock price does this have to be realized at? Now, we know that I bought these options at a strike price of $92. Now, if the price stayed at $92, literally by the time that these contracts expire, I would be at my max loss, which gives us point number 1, which is indicated by this little purple thing that I put on the graph here. All right, now the second thing we need to know is how much does the stock price need to increase for us to start making profits? Now, the easiest way that we can actually calculate this is by knowing how much we paid for both the call and the put option. Now, we know what I paid for the call option, $5.60, what I paid for the put option, $5.35. And in total, again, this gives us $1,095 with commissions, blah, 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 blah. It gives us $11.19. Now, this $11.19, this is going to be applicable for both points that we're going to calculate. So I'm going to keep this in the top left corner for our reference so that we don't have to do these calculations all over again and confuse you guys. Now, this $11.19, we would just add this to our strike price of $92, which would give us $103.19. This would then give us our first point, which I have put with the red dot on the right side. This means that the stock price would have to go over this $103.19 for us to be making profits. Got it? If you need to replay it a couple times, by all means do what you gotta do and then come back to this part again. Next, we need to find out at what stock price would it have to decrease by for us to start making profit. Now this is going to be easy because with this top left price that I've put in the corner being $11.19, rather than adding it to the strike price of $92, we're actually going to be subtracting it from the $92. So 92 minus $11.19 gives us $80.81. This automatically gives us our second point, which I've put on the left red dot on this chart. Now, what this means again is that the stock price has to go lower than $80.81 for us to start making those big dog gains. Now, believe it or not, I actually ended up selling this play on July the 15th because I ended up looking at it one day. I'm like, wait. I'm at a 7% gain and my target was 4%. I'm selling this ASAP because I ended up defining what I wanted to sell this at and I had to make sure that I stuck with it. But I was kind of lucky and got an extra 3%. And this was pretty dope because it only took me 2 weeks to make 7%. Like, where do you see those opportunities coming in a time of uncertainty, right? So whatever, I sold the call at $7.75 and I sold the put at $3.95. Now, without bombarding you guys with too much maths, all I did was just subtract both of these numbers from the original price I paid for them. Pretty straightforward maths. I'm probably gonna keep doing plays like these until there's some sort of like confidence within the market. Whether I know, okay, you know what, we're gonna keep going up, or hey, you know what, we're gonna keep going down. Then I'm gonna start switching up my strategy, and this is probably the thing that you have to understand the most with options. Like, you gotta stay on top of the game and adjust to your strategy to whatever's going on in the markets or within the certain stock that you're looking at. Now, I'm gonna post all of these pictures and all of these graphs that I put on the Instagram. So if you don't already follow us, be sure you do in the Instagram handle that you'll see pop up on the screen. Z Community Cuties, again, if you have any questions, let your boy know in the comment section down below. And again, thanks for watching this. Tamara Z signing out. Peace.